These reports about Ken Lewis and pressure to complete the Merrill Lynch deal raise some big questions. For answers, we turn to an expert, Jim Smith, a lawyer who is co-chair of the Securities M&A and Corporate Governance Litigation Group at the firm Dewey Leboeuf. He's here with us in the New York studio. Jim, a lot of questions here. Obviously, the big one is, does it appear, based on what you've seen thus far, that people such as Ben Bernanke, for example, maybe even folks at the Treasury Department, overstepped the limits of their authority?
Well, I think, Eric, we need to be kind of circumspect here because we don't have all the facts yet. You know, we've seen some emails, we've seen a memo from the Republican staffers, you know, we've heard a little bit from Ben Bernanke, and we've seen Ken Lewis's prepared remarks, but the evidence isn't really in on that. Now, as to whether any federal officials overstepped, so to speak, the way I look at this is really a question of what Ken Lewis was doing. And people need to bear in mind that in mergers and acquisition transactions, pressure is brought to bear on CEOs of public companies all the time by all sorts of constituencies, creditors, financing, labor unions. And I don't care whether it's the federal government or somebody else. The question is really how the CEO and the board of directors of the corporation react to that pressure.
Jim, what's the worst case scenario? I mean, could we see the government get sued over this?
Well, I think we're pretty far down the line from seeing something like that. You know, we do have a lot of turnover, Deirdre, on the board of directors at Bank of America recently. We've had 4 board members leave, 4 new outside independent directors come in, and the direction that an independent board might go, depending on where these ongoing investigations lead, is kind of hard to handicap. But I will say this: if the federal government wants to be a player in the financial sector and not just a regulator, then I think the good comes with the bad.
They said they don't, though.
Well, they've said they don't, but actions speak louder than words. And if you want to have a seat at the table when these sorts of negotiations are going on, then you take the good with the bad. And independently minded board of directors in this environment, if they could go out and hire a Chris Clark or some other fire-breathing former prosecutor, and I don't know that anyone is necessarily safe in terms of looking back at how these things were done.
Jim, quickly, you say that it all comes down to what Ken Lewis did, but as you know, this congressional committee doesn't really care about Ken Lewis, even though they've called him to testify. They care about Ben Bernanke, they care about Tim Geithner, they care about whomever, Paul Volcker, Larry Summers. So what does it matter to these people what Ken Lewis did or didn't do?
Well, as I said before, I think understandably, for a whole host of reasons, political and otherwise, the focus is on the actions of Hank Paulson, Ben Bernanke, and the other federal regulators here. And, you know, we have the instantly infamous Jeffrey Lacker email. Management is gone, and so.
But he was saying management would be gone only if Bank of America came back to the Fed to ask for money.
That's right. I think the point there was, you know, there's really 2 issues out there. Was there pressure brought to bear at anyone on Bank of America not to disclose what they were learning in real time about the financial condition of Merrill Lynch, on the one hand? The other is the pressure that was brought to bear not to declare a MAC. I think the latter of those 2 is probably the more significant and the one to which that Lacker memo was addressed.
All right, Jim, hang on one second. We're going to take a short break, come back for a little more discussion on this subject. We're talking to Jim Smith of Dewey Leboeuf about those explosive emails in a House Republican memo concerning the pressure that may or may not have been brought to bear on Bank of America to buy Merrill Lynch. Stay tuned, everyone. We'll be back in 2 minutes. Continuing our discussion of the Fed emails concerning the Bank of America Merrill Lynch deal, we're back now with Jim Smith, the co-chair of the Securities M&A and Corporate Governance Litigation Group at the firm Dewey Leboeuf. Jim, what could happen to Ken Lewis here? He's been stripped of his chairmanship at Bank of America. You mentioned that, a lot of changes on the board, but could this backfire? We know that he's wanted to get out and address this issue. It seems as though, even though he hasn't come out publicly, he's certainly providing this testimony and making it clear that he felt pressured. Could he end up losing his job as a result?
Well, I wouldn't want to handicap the chances of Mr. Lewis losing his job, although I do think, as I said before, the focus here is kind of on his actions and the role of the federal government in affecting the way Bank of America and its board of directors proceeded. Look, Mr. Lewis has said in his prepared remarks, and I take him at his word, that there were a couple of interests that he had in mind in making the decisions back in December. Those interests were the interests of the financial markets, the economy, the country, and the shareholders.
But did he make a mistake in threatening to invoke the MAC clause?
I don't, whether he made a tactical mistake in the negotiations or not, I don't know. I think at the point in time where that was surfaced with the government, based on what I've seen, I think it was the honestly held belief of the people at Bank of America that there may have been a MAC. And whether at the end of the day the decision not to invoke the MAC clause was as a result of this alleged pressure that was brought to bear and concern over his job or other things, or whether it was good faith, fiduciary duty, and the interest of the shareholders, I think, you know, we're pretty far down the line before we can answer those sorts of questions.
All right, but bottom line, it was his decision to make. Jim, thanks very much. Jim Smith of Dewey Leboeuf.